Hi, this is Jason, Chief Technical Analyst with ToroAlerts with your weekly market recap for the week ending December 2nd. Let's dive into the charts and take a look at what we're seeing. Starting out with Bitcoin here. Bitcoin has been sitting in a bit of a bull flag at the moment, so at least in the short term, things are looking somewhat bullish for Bitcoin. Looks like there might be a good chance that we get up to maybe 18 or 19K on Bitcoin in the short term. So there might be a decent setup for a short-term trade here, but more medium to long-term, I'm still fairly bearish. I think the bottom is not in on Bitcoin yet, and so I'd be very cautious going into any trades unless you have a really precise plan on when to get in and out. If we're dropping below 16, then I think we're definitely heading lower from there. But right now, it looks like we're in a bit of a bull flag and a pretty good chance that we get up to maybe 18, 19K, possibly even a little bit higher on this short-term, looks like a short-term rally that's going on right now for Bitcoin. And then when we take a look at Ethereum, looking at Ethereum's price action, also looking like we're in a bit of a bull flag, good chance that we potentially head higher in the short term on Ethereum. If we do, I'd probably be looking for somewhere between about 14 to 1500 for probably a top on Ethereum. Might also be looking at a potential top around 1450, which would be the 200-day moving average. So definitely looking like there is some short-term positive momentum in the crypto space right now, but I do think it's going to be fairly short-lived. So I'm just staying away from the crypto trades personally for the moment, but it does look like there are maybe a couple of short-term trade possibilities in the space currently. So let's dive over to the traditional markets and take a look at those. Those have actually been quite a bit better looking than the crypto space recently. We've had a nice rally in S&P 500 starting back in about middle of October, and that's continued since then. And it looks like we're up against some really key resistance now. When we take a look at the SPY chart here, we can see we've had this down channel trend line in place since the beginning of the year. The last 3 times we've tested that, we've failed off of it and failed pretty hard, and it was a pretty quick sell-off from there. So that's, I think, what a lot of people are assuming is that we'll see that happen a 4th time. But based on a lot of the things I've been seeing in the markets and a lot of the charts that I watch, I think there's actually a decent chance we might break through this time. But I am still being somewhat cautious around this area as we're just retesting that down channel trend line for the 2nd time now. Going into the market Friday, we basically got right back up to there and bounced off of it just slightly. So, but we did close the week out above the 200-day moving average, which I think that's a pretty bullish sign, at least in the short term. And but I'm definitely waiting for a clear indication that we can get above about 410 on the SPY and break that trend line. If we do see price action get above that trend line and hold that, then I think there's a pretty good chance that the rally continues going into the end of the year. And so that's what I think a lot of people are hoping for, and I think there's a decent chance that could happen, but we do need to get that proven first. We need to see a couple of days of price action close above that trend line. And then we also have this Fibonacci extension level right around 414 that could be a bit of resistance. But if we see 415 plus on the SPY, then I think that'll be a pretty bullish signal that we'll see that year-end rally. Then take a look at our breadth. One of the many reasons that I think there's a decent chance this rally can continue, we can see in the breadth measures we're at about 91% of all S&P 500 stocks above their 50-day moving average, which is certainly a positive sign. And but more of the metric that I think is even more positive looking is that this number of stocks above their 200-day. So the last rally we had in the S&P, we actually saw a lot of stocks get above their 50-day, but they didn't. Only about 50% got above their 200-day. So we had about a 90% participation on the 50, but only about 50% above the 200. So now we're seeing in this rally, we're actually seeing almost 64% of stocks above their 200-day, and then also over 90% on this rally above their 50. So that's telling me that we've got just better overall breadth and price action in the markets because we've got a lot more stocks that are above their 200-day now, as well as the 50. So that just shows some improving metrics in the market, and I think it's one of many signals that are indicating that maybe this rally will continue. And then we take a look at our NASDAQ, our triple Qs. This has been the most beat up sector during this year with the sell-off, but it is also looking pretty bullish. And but we still do have this down channel trend line to continue, and we are not above our 200-day moving average. We're actually above the 200-day moving average on both the S&P and the Dow Jones Industrial Average currently. but we are not on the NASDAQ. So those are a couple of areas that we need to contend with, and I think there's a good chance we do go up and test both that down channel trend line and the 200-day, and then we'll have to see where we go from there. I'm a lot more confident in the S&P potentially breaking that trend line than I am on the NASDAQ, but it's possible that we see the NASDAQ break through as well. So we'll be watching that 200-day down channel trend line really closely on the triple Qs, and that's likely going to line up somewhere around the, say, 300 or so to about 303, 304 on the triple Qs. Just kind of depends on how long it takes, how many days it takes us to get there, but that'll be a key level I'll be watching on the NASDAQ. And then when we take a look at the Dow Jones industrial averages, we talked about how we are well above the 200-day moving average already on this one. We are also above, just slightly above our previous rally on the Dow back in August where we peaked out. And so that's also looking pretty bullish for the industrial sector. And when we take a look at the transports, in order to confirm that, using Dow theory, in order to confirm that move, we'd want to see the transports get above the August highs as well, which we'd want to see about 15,200 on the DJT. And if that happens, then I think that would confirm our move and signal that we'll probably get a year-end rally. But this is already starting to look pretty bullish. We got a bit of a bull flag formation going on in the transports. We're above the 50-week moving average now. We've also broken this trend line, and we're also above this Fibonacci extension. So we really had three areas of major resistance on this chart that we've managed to get through so far. And so as long as that holds, I think there's a pretty good chance we at least get up and retest that. And then if we do see it get above that 15.2, then I think that would be another signal telling us that this year-end rally is very likely. And then when we take a look at our Russell 3000, we've got a real key moment going into likely at least in the next week or two. We should get some resolution out of this, as we are up against pretty close to our center channel on this Russell 3000 chart. This channel line goes all the way back to the Great Financial Crisis, so there's a lot of price memory and history on this channel, and so I think it's pretty significant, and there's a good chance that we're going to get above that, I think. And if we do, that would definitely be a bullish sign for the markets, because we would not only break this down channel trend line that's been in place all of 2020 and really going back into 2021, but we'd also be clearing the major moving averages and getting back up above that center channel. And so I think that would be a very bullish development for the markets in the short term. But we're not quite there yet, so I think in the next week or two we'll likely get an answer to that on this chart, and if we do see it break, then that would definitely be a good sign for the markets in the short term. And then we take a look at our Russell 1000, our IWB. We are just below the 50-week and a Fibonacci extension level, so the bulls would want to see that break probably about 232 on the IWB, and that would definitely be a good look for large caps, because we'd be clearing all the major moving averages and getting above that Fibonacci extension level. Last August, when we peaked out, it looks like we topped out on large caps right around 238. So hopefully we can see that break this time and then head even higher, and that would definitely support a year-end rally in the large caps. And the small caps are actually looking pretty good as well. We're seeing them been holding support on that 200-week moving average really nicely. We've also been kind of trapped between this anchored VWAP position, but this last week we actually broke above that and then tested the 50-week moving average. So if we can get above that 50-week moving average, that'll be really bullish for the small caps, and I think there's a good chance that we get back up to 204, 205 on the IWM, and that would be another bullish sign for the markets broadly as well. And then we take a look at our growth versus value. Growth has been definitely not the place to be this year. Value has been the clear outperformer, but we have had a couple of periods where growth has had some periods of time where it's outperformed value. That occurred around the end of May, early June, into that August rally that peaked in August. We did see growth outperform value, and now it looks like we're at least kind of on parity with growth and value over the last few weeks. And if we see growth break this trend line and continue higher, then I think there's a good chance that we see potentially growth outperform value in the short term once again. But for now, it's looking like it's about even between growth and value. And when we take a look at our sectors that we watch, This is for the last 5 trading days, so for the last trading week in the markets. I like to look at these so we can see where the sector strengths are in the marketplace, and this week is the first time in quite some time we've seen the cannabis sector at the very top of the leaderboard, up over 10%, almost 11% in 1 week, which is very impressive for really any sector. And so cannabis is looking really good in the short term. I think a lot of that was driven by the law that was passed by Biden. It was the first federal law, I believe, ever passed for cannabis, but it really was just around medical research, so I don't know if that's really going to necessarily sustain that rally. It could be. A lot of times these things occur kind of on a federal level, and there'll be a spike in cannabis, and then they typically sell off pretty quickly thereafter. But this one I'm watching closely because we're seeing a much stronger rally than we've seen in previous ones. And if we continue to see a sustained rally in cannabis, I'm definitely keeping a close eye on it for the first time really in about a year, looking for some potential opportunity for some cannabis trades. So I'm keeping a close eye on that one. Other sectors that I'm really liking right now is gold and silver. Those are starting to look really bullish. We'll get into those charts shortly. But silver was the second on the week, up by 8%. We also saw some really good strength out of online retail, about 7.5%. And then other sectors that were up about 6% were biotech, ARC Innovation, FinTech, and Lithium Fund. All looked really strong, up about 6% or so. And then at the bottom of our sectors for the week, natural gas was the worst performer, down almost 16%. Natural gas has been extremely volatile recently. It's actually been a really nice trade, but I'm out of it currently, and I'll be watching that one closely because there tends to be a lot of up and down swings in natural gas, especially recently. And so it has been a nice swing trade, but right now it's definitely getting beat up pretty hard. We're also seeing energy and oil and gas exploration down in the red pretty good as well on the week, and I think a lot of that has to do with some of the geopolitical stuff going on. There's some things in Europe going on around new energy policies with Russia that are going to start next week. And we also saw America do some sort of a deal with Venezuela that's going to bring potentially more oil onto the market from them. And so I think some of these factors are pulling oil down in the short term. And we'll go ahead and jump over to the oil chart, and we'll talk about what I'm looking for on a bottom on that. So when we look at our oil chart, things are looking like they're probably heading lower again. We have double bottom up that 76.50 a couple times, but I think there's a good chance we retest that again and potentially head lower. If we do see that break, then I'll be looking for about $70 to $72 a barrel as a potential kind of floor for this sell-off. And if we do hit that $70 level, that'll be an area I'll be watching price action on the energy stocks very closely and potentially looking for some bottoms in energy. And I think that might be a good setup to get back into the energy trade once we hit that $70 price target on oil. I still think long term there's a lot of reasons to still be bullish on the energy sector, and this is, I think, more of a short-term price correction that's likely close to resolving, and then I think it'll be back into the green for the energy markets. And so keeping a close eye on that one and looking for that $70 barrel for a potential re-entry into the energy trade. And then when I look at the CRB Index, we saw the CRB move up a bit this week, but I still think it's just kind of been chopping around fairly sideways for quite a few weeks now. We are below the 50-week moving average, and what I'll be looking for potentially a short and potentially also a good indicator that inflation is continuing to go lower would be a clear break below that 267 level on the CRB. That could set us up for a decent short down to about 243 on the CRB Index, and I think it would also just be good news for the inflation narrative, because obviously if the CRB Index is going down, that's a lot of our commodity prices that are heading in the right direction, so that we can hopefully get out of this inflation issue we've been dealing with for a bit now. When we take a look at our global markets, the VEU, this is the global markets minus the United States. We can see that they've actually been performing really well, and we broke a significant trend line just a few weeks ago, and so things are looking pretty bullish for global markets in the short term. I think a big reason for that, though, is the falling dollar. I don't think it's a coincidence that when the dollar started falling, that's when we started seeing this chart move up and to the right. And then also we're obviously experiencing a bit of a rally in American markets as well. But I do think that both the rally in global markets as well as American markets is going to be fairly short-lived, but I'm at least trading it to the upside for as long as we can, because I do think there's a good chance that we'll see global markets as well as American markets potentially have a good rally going into the end of the year at least, maybe even into a little bit of Q1. And then we take a look at our high yield corporate bond ETF, the HYG. definitely a bullish signal, seeing it get back up above the 75 level. That's been a key area of support and resistance that we failed to get above last week, but we got above it this week. So I would assume that we'll probably see HYG continue to head higher, and be looking for areas of resistance right around 78 or so, which would be our 50-week moving average, and or could potentially see HYG get back up to the 79.50 level, which was where it failed last time before it started selling off again. And then taking a look at our precious metals. So we talked about earlier in the sectors that we saw silver was one of the best performing sectors on the week. And we can see here, looking at the gold chart, gold also had a really strong week. Just about, these are weekly candlesticks, so about 5 weeks ago we were sitting at about 152 on the GLD, and now we're all the way back up to 167, almost 168 on the GLD. We got all the way up to the 50-week moving average and kind of failed off of that. So we'll see if we can get above that going into next week. If we see the GLD get above those moving averages, we'll have cleared all those weekly moving averages, and that'll be a pretty bullish sign for gold. And gold's also very inversely correlated to the 10-year, and we'll get into the 10-year chart shortly. But we're definitely seeing that start to roll over as well, and I think there's a decent chance the 10-year interest rates are likely have peaked. And so if that is the case, then I think that would continue to support a rally in the precious metals market. And I'm already in a couple of trades, trading some of the gold and silver miners, because when gold and silver move up to the upside, I typically like to look for trades in the miners and not the metals themselves. I'll invest in the metals and hold them long term, but I'm generally, as a trader, looking for more alpha in the short-term swing trades, and those gold and silver miners typically give you that, and oftentimes move with the price of the metals. And so if it's a bullish situation for gold and silver, it's almost always a bullish situation for the miners as well, and we're seeing that play out right now. And then taking a look at our silver chart, you can see silver had a real strong move above the 50 week, so it's actually cleared a lot of the moving averages, although there is one more moving average to contend with, which is sitting right around 21.75 on silver. So we'll see if we can get above that one, and that would definitely be real bullish for silver if we get above the rest of those moving averages. But we are already above the 200 and the 50, and we had a very strong move out of silver. Just in the 1 week, we started out about 1950 and closed out at about 21.29. And so both gold and silver are looking pretty good, and definitely looking for some trades in that space now. And then taking a look at our interest rates, we can see our 2-year went down this week. We started out the week at about 4.5, finished off about 4.25. So it's looking like potentially there could be a top in the 2-year. We're also seeing a drop below that 10-day EMA, which is the first time we've closed on a weekly basis below that. Really, there's only 2 times since this rally in rates has really started. And so if we could see a second week where we're below that EMA as well, that could, I think, even signal a stronger sign that maybe the rates have topped in our 2-year. But the 2-year, I think, is if there's any rate that could potentially go higher than it's already been recently, I think the 2-year maybe would be it. But when we take a look at our 10-year, I think there's actually a really good argument that the rates have peaked here. So when we use Elliott wave analysis, we can see a pretty clear wave 1 up to the upside here, and then a wave 2 correction. Your wave 3 to the upside typically is 1.618 extension off of your first wave, which it actually came up to almost exactly. Then we saw that wave 4 correction to the downside, and then ultimately a 5th wave up, completing a 5-wave structure to the upside. And typically that means you've got an end of a pretty significant move. And this is using Elliott wave for really from the COVID lows all the way up till now. And so it looks pretty likely that the 10-year rates have peaked, in my opinion. And I think that's also supporting the move in seeing the gold and silver prices move to the upside as well. So we are just up against our 21-day EMA. We've clearly got well below the 10-day. And then we also are at this 3.5% level, which is a pretty major area of resistance. So we closed just below that. So we might see a little bit of a bounce maybe next week. We might see a move to the upside in the short term above that 3.5. But if we do see it get below that and below the 21-day EMA, then that would continue to be even more bearish, I think, for the 10-year, and we'd likely see it test either 3.25 or maybe even 3%. And so those would be some of the targets I'd be looking at to the downside on the 10-year. And then we look at our 30-year. Similar story. We've looks to me like we peaked in our 30-year as well. Peaked out right around 4.5%, and now we're just about what do we got here? 5-6 weeks since we peaked, We're now sitting at about 3.5% on our 30-year. So some targets to the downside. It looks like probably 3.25 would be an area if we see it drop below that 3.47. Would be kind of the next area of support to the downside on our 30-year. And when we take a look at our VIX, we had a pretty major development in the VIX this week. So the VIX is closed at the lowest level it's been at since April of this year, and so that's a pretty significant development. We've seen a very high volatility year in the markets, as we've seen a lot of selling pressure. And a lot of times when we've gotten down into this range, it's typically when we reversed, and then ultimately the selling happened again, and ultimately that hasn't occurred so far yet, and we are also seeing a close below some of these other previous bear market bounces that ultimately failed. And so that's an interesting development that I'll be watching closely on the VIX, but we are definitely seeing our volatility levels at some of the lowest levels they've been at for the entire year. And when we take a look at really for the entire calendar year of 2022, other than at the beginning of the year in January, we really haven't seen volatility readings below about 18 or 17. And so if we can see it continue to stay below 20 for a while, that would be pretty interesting. I think it would likely continue to support this year-end rally. And our put-call ratios in normalized ranges, we have seen some spikes above the 1 level, but currently it's below that in a pretty normalized range, so there's no elevated put buying protection in the markets currently, it doesn't look like. And then when we take a look at our dollar, definitely I've kind of had an opinion change on the dollar recently. I was thinking that potentially we might have one leg higher in the dollar, but when I was talking about that, I said that one of the things that would potentially make me change my mind would be seeing some multiple closes below that 200-day moving average, and I think if we see the dollar drop below this 103.85 level, I think that would really probably be the nail in the coffin, and would definitely make me really confident that that dollar top is likely in. We are definitely seeing a major trend shift in the dollar, and when I did a redo on my Elliott wave count on the dollar index, it looks like there's definitely a count that would make sense that would suggest that when we peaked at about 115, that very likely could be the top in the dollar for now. So if we continue to see a dollar dropping, that could definitely support a Bitcoin rally, as long as we don't have any more blow-ups in the crypto space as far as bankruptcies go and whatnot. But as long as there's no more kind of macroeconomic negative news in crypto, if we continue to see the dollar fall, then that can definitely support a bit of a rally in Bitcoin, which we're currently seeing a little bit. And then it also can typically a dollar going down is usually good for global markets, emerging markets, and also for U.S. markets. And so it's definitely, I think, an overall positive that we're starting to see the dollar turn the other direction, as it's been just on a tear to the upside really all of this year, and in a much slower fashion last year as well. So it's definitely looking like a pretty significant trend change in the dollar as well. And then when we take a look at our yield curves, we like to look at those on a weekly basis, because this, I think, gives us good longer term perspective, especially when we're seeing historic readings on these yield curves. So we're seeing almost a negative 0.8% on the 10-year minus 2-year, and on our 10-year minus 3-month, we're seeing a negative 0.722%. So these are both historically low readings. We can go back many decades on this chart, and they've never been that negative. And all we really need for these yield curves, typically almost every time we get below the zero line, it signals a recession. And so we've not only got below the zero line, but we are at historically negative readings. So I think that is a bit of an ominous warning for the future, suggesting that we're likely going to have a pretty steep sell-off, I think, in the markets going into 2023. But that's more to worry about, I think, going into next year. So far, things are looking pretty good in the short term. This will likely be one more rally to the upside before a pretty deep sell-off, in my opinion. And let's go ahead and close out the week with one of my silver trades that I'm in. This one I've been in for a little bit already, but I still think there's some good upside left in this trade if you were to get into it. We've got some real nice price action breaking a long-term trend line. When we zoom out on this one, we can see that the silver mining company, Pan American Silver Corp, ticker PAAS, had topped out at about 30.50 back in looks like April of this year, and since then has just been on a really steady decline. We're at 30.50 a share, and we bottomed out at about 13.50 a share. So this stock just got really beat up, and a big reason for that was silver prices really were getting beat up for most of this year as well. But now we've seen that trend change. We've got a big break off of this descending wedge, We've also seen price action get all above all the moving averages, so this is definitely starting to look even more bullish than from when I originally got in the trade right after it broke that trend line. But it looks like there's still probably another 20% or more to the upside. I'm going to be trading this one looking for that $21 price target, which would get us a gap fill in the chart. And so that's what I'll be trading it for and taking profits if we hit that $21 level. And there's still a pretty good exit point, I would say, probably right around, just if it dropped below 16, you probably get out of the trade with a pretty small loss, and I think there's still a lot of good upside in this one, looking for that $21 price target. So thanks for tuning in this week. Make sure to download the ToroAlerts app on the App Store, and check us out on our website, ToroAlerts.com, and we will see you next week.